In this video, we'll learn about disclosures related to matrix and scenario analysis. Numbers alone don't tell the whole story, especially when it comes to climate risk. Under AASB S2, matrix and analysis isn't just about tracking emissions or targets. It's about using real data to drive better decisions, prove your progress, and win the trust of investors and stakeholders. In this section, you will discover how the right matrix reveals financial risk, uncover opportunities, and set your business apart. Let's move beyond box ticking, learn how to measure what matters, translate climate impact into action, and make sure your reports drive meaningful change. Ready to master the numbers that truly shape your future? In the next few slides, we're going to look at some of the important metrics around emissions reporting. When it comes to climate risk, climate related financial disclosures, metrics are more than numbers, they are signals. They tell your board, investors, and your auditors where your business is heading and whether your strategy is credible. Let's start with the basics. We got scope 1, 2, and 3 emissions. These cover your company's full carbon footprint. Scope 1, as we discussed, are direct emissions from fuel or gas your company burns, like diesel trucks or factory boilers. Scope 2 is indirect emissions from electricity you buy, your office lighting, warehouse operations, and cooling system. Scope 3 goes further. It includes emissions from your suppliers, logistics, and even how customers use or dispose of your product. Tracking these emissions help you see or understand where your biggest risks are, what are the biggest opportunities which are in hiding. Whether it's a high emission supplier or an inefficient product, it gives you a starting point to engage, improve, and disclose with confidence. Next, financed emissions. If you work in banking, insurance, or asset management, this is a key. You're not just disclosing your office footprint, you're disclosing the emissions of the companies you fund. Uncovering financed emission tells you how exposed your portfolio is to a high carbon industry and whether your capital is aligned with climate goals. Then we have water usage. Why water? Because climate change isn't about carbon, it's also about resource scarcity. If your operations rely on large volumes of water, like in agriculture, mining, or manufacturing, tracking usage helps you plan ahead and manage regulatory risk and avoiding operational disruption. So the important things to remember on the slide is you don't need a perfect system to get started. Start with what you already have, like your bills related to fuel and electricity, supplies record, investment reports, and water meters. Then use that insight to build a baseline, set targets, and communicate clearly with your stakeholders. Because in today's climate reality, good matrix doesn't support just reporting, they drive better decisions. Now let's look at this slide. The first one we're going to discuss is capital deployment. This is about tracking how much your business is investing in climate related initiatives like research and development, renewable energy, cleaner technology, or infrastructure upgrades. If you're spending money on decarbonizing or adoption, this is your chance to show it. Now, why does it matter? Because it signals to your board, investors, and stakeholder that climate action isn't just talk, it's backed by investment. And it allows you to assess the return of that investment over time. Then we have carbon intensity. This is about efficiency. How much emissions are generated per dollar of revenue or per product. It allows you to benchmark performance across departments or compare with peers. For example, there are two factories that might have the same total emission, but if one produces twice the revenue, it's much more carbon efficient. This metric drives smarter product and process decisions. The next metric is green revenue and green asset. This tells you how much of your business is already aligned with low carbon economy. This could be revenue from energy efficient products, services that support circular economy, or investments in sustainable projects. Why is this powerful? Because it shows progress, not just risk. And it opened doors to sustainability linked financing, ESG investors, and green bond. The next important matrix is scenario analysis output. Here you're testing how your business performs under different climate futures, like a temperature rise of 1.5 degrees Celsius, 2 degrees Celsius, or even 4 degrees Celsius. Are you exposed to regulatory changes? Will your cost spike due to carbon pricing or supply disruption? These scenarios will help you stress test your strategy. So if you're not planning based on these important factors related to climate, your future might be at risk. So it's very important to perform scenario analysis. Is going to stress test your strategy towards the future and make your company in a stronger position. When it comes to climate strategy, it's not enough to report where you are. You also need to prepare for where the world might be going. That's where scenario analysis come in. Think of it as a climate wind tunnel. You test your business models in different futures and see how it holds up. Let's start with a temperature rise of 1.5 degrees Celsius. This models a world where the global action is strong. Government moves fast, regulation is tight, and emissions fall sharply. In this scenario, businesses are forced to pivot quickly. You could face carbon taxes, pressure to exit high emission assets, fast moving competition in green markets. If your strategy can't adapt, you risk falling behind. Now let's look at the other hand, a rise of 2.5 degrees and above. This is the world where we act too slowly. Here physical risk becomes severe. Think heat waves, droughts, floods, food shortages, and rising insurance costs. If your operations or supply chain rely on climate sensitive region, this future hits you hard and it's expensive to adapt in hindsight. That's where scenario analysis isn't just about risk, it's about resilience. Remember, scenario analysis heavily depend upon your assumptions. What carbon price did you use? How quickly will your technology shift? What does your energy mix looks like in 5, 10, or 20 years? You also need to look at multiple time horizons, short term, medium term, long term. Because what looks safe today might be unsustainable a decade from now. Take the example of AgriGrow, a mid-sized agriculture company. In their 2.5-degree scenario, they realized rising temperature and fertilizer volatility would hit yields and cost very hard. So they invested early in drought-resistant crops and diversified their suppliers. That one decision made them more resilient, more competitive. So here's the takeaway for you. Scenario analysis help you move your climate thinking from reactive proactive, from uncertainty to insight, and from risk avoidance to opportunity identification. So ask yourself, can your business strategy survive in a 1.5-degree temperature rise? And how would it be different if it's a 2.5-degree temperature increase? Because these are new reality on the basis of which we need to plan our future. Now, pick one climate metric for your company, like emissions or energy use. Imagine two climate scenario, one optimistic, one challenging. How does your chosen metric change in each case? What business decision would you make? Spend 5 minutes sketching your answer. This is how real insight begins. Stay tuned to learn more about ASBS2. Thank you for joining.